The dollar didn't lose an ally, it lost a requirement. In 2024, cargoes of crude moving from the Gulf to Asia began settling in currencies that never touched New York's clearing system. Not in theory, not in pilot language, but in repeat transactions between state-backed energy firms and refiners who care more about pricing stability than financial symbolism. The United Arab Emirates is still embedded in U.S. security architecture, still pricing much of its oil in dollars, still holding vast dollar reserves. None of that has changed in any dramatic sense. What has changed is something quieter, the removal of the assumption that every trade must eventually pass through dollar conversion. The practical shift shows up first in how oil contracts are structured, not in political announcements. A crude shipment leaving the port of Fujairah or Ras Tanura is still priced against benchmarks like Brent or Dubai crude, but the settlement leg can now be separated from dollar clearing in ways that were not operationally common a decade ago. In some cases, Chinese refiners and Gulf suppliers settle through yuan accounts held in offshore clearing banks, reducing the need for immediate conversion into dollars. It does not erase dollar pricing, it removes a step in the chain. The UAE-China trade relationship is where this becomes visible at scale. China has been the UAE's largest trading partner for several consecutive years, and energy flows are only part of that system. Logistics, telecom infrastructure, and industrial equipment trade increasingly operate through mixed currency invoicing. The key detail is not that the UAE is switching currency allegiance, but that its institutions are comfortable maintaining parallel settlement channels depending on counterparty. That is structurally different from the post-1990 default of dollar-first clearing. This matters because the dollar's power was never just about reserves. It was about friction. Every forced conversion into dollars created demand, a structural pull that made the system self-reinforcing. Remove even small parts of that loop, and the reinforcement weakens without any visible break. According to BIS Triennial Central Bank Survey data, the dollar still dominates global FX turnover, involved in roughly 88% of transactions. That number has barely moved in years. But that stability hides something else. Turnover concentration is not the same as settlement necessity. SWIFT messaging remains heavily dollar-weighted, but alternative payment rails like CIPS and bilateral central bank swap lines have expanded the number of routes available for non-dollar clearing in specific corridors. The system is not shrinking, it is branching. In the background, China's financial plumbing has been expanding through the Cross-Border Interbank Payment System, CIPS, which in 2024 processed record volumes of yuan settlements. Still small compared to SWIFT, but that comparison misses the point. SWIFT is messaging. CIPS is settlement intent. They are not symmetrical systems, but they begin to overlap in specific trade corridors. The stakes are not collapse. The stakes are optionality. And optionality, once it becomes habitual, rewires behavior faster than policy statements ever could. Opinion line. I think most analysts are still measuring dollar dominance through reserve share and FX turnover, while the real structural change is happening in whether the dollar is still a required intermediate step in trade settlement. Doubt. But I am not fully convinced that these alternative rails can survive a major global liquidity shock without reverting back into dollar dependency under stress conditions. Prediction. Over the next several years, more bilateral trade will continue to price in dollars while quietly removing the obligation to settle through them at every stage. And that is where Washington's perception lag starts to matter. From the outside, nothing looks structurally broken. Treasury demand remains strong. Oil is still dollar-priced. Sanctions still function when deployed. But operational finance does not shift through policy signals. It shifts when enough counterparties discover they can finish the same transaction without touching the same bottleneck twice. The dollar is not being replaced. It is being bypassed in specific high-value corridors. And the UAE is one of the earliest places where that bypass stops being experimental and starts becoming routine. That distinction is where the story actually begins. The mistake is to treat this as a currency story. It isn't. It's a routing story disguised as a currency story. If you strip the politics away for a moment and look only at transaction design, most global trade still follows a surprisingly rigid sequence. A contract is priced in a reference currency, usually dollars. Financing is arranged through banks that manage currency exposure. Insurance and freight risk are priced in dollar-linked instruments. And even when the buyer and seller are non-American, the system often snaps back into dollars somewhere in the middle of the chain. That somewhere in the middle is the real center of gravity. What has started to change in corridors like UAE-China energy trade is not the pricing anchor, but the number of times the system is forced to return to that center. Each return is a conversion event. Each conversion event is a demand event for dollar liquidity. And each avoided conversion weakens the automatic loop that used to make the dollar unavoidable. There is a technical term in trade finance for this: currency intermediation layers. And for decades, the dollar sat inside almost every layer by default. Now look at what happened after 2020, not in speeches, but in infrastructure. China expanded swap line agreements through the People's Bank of China with multiple trading partners, allowing central banks to access yuan liquidity directly in stress conditions. The UAE became part of that network. India expanded rupee settlement mechanisms for certain oil imports from Russia after sanctions disrupted dollar-based payment channels. Russia, removed from parts of SWIFT after 2022, rebuilt settlement pathways through a mix of ruble-linked and partner currency systems. Individually, these are adaptive responses. Together, they form a pattern: the gradual construction of parallel settlement escape routes. And here is where the UAE matters more than it appears at first glance. It is not a sanctioned economy. It is not isolated from Western capital markets. It is one of the most globally integrated financial hubs in the world. Abu Dhabi sovereign wealth funds, Dubai logistics networks, and a banking system deeply connected to London and New York. So when a system like that begins to experiment with non-dollar settlement in specific trade segments, it signals something different from geopolitical defiance. It signals risk management through redundancy. In financial engineering terms, redundancy is not inefficiency, it is resilience. There is a historical echo here, but it's not the one people usually reach for. It's not Bretton Woods collapse or sterling decline in isolation. It is closer to the euro-dollar system in the 1960s, when dollar liquidity began circulating outside U.S. jurisdiction through offshore banks in London, creating a parallel monetary layer that Washington did not fully control, even though it was still denominated in dollars. The irony is important. The dollar has already experienced decentralization once. What is different now is that some of the new layers are not dollar-denominated at all. That is the subtle shift. Opinion line. I think the real blind spot in U.S. analysis is assuming that as long as trade is priced in dollars, structural dominance is intact, when in reality, settlement independence can slowly erode that dominance from underneath. Doubt. But I also suspect that any large-scale crisis, energy shock, liquidity squeeze, or capital flight, would temporarily snap these alternative systems back into dollar reliance, revealing how conditional they still are. Prediction. In the next cycle of global stress, we will likely see both systems operate simultaneously: dollar clearing as the emergency backbone, and non-dollar settlement rails absorbing routine flows that never return. And that creates an uncomfortable asymmetry, because Washington can still influence the cost of using the dollar system. It can still sanction, still regulate, still anchor global liquidity through the Federal Reserve. But it cannot easily observe every parallel settlement decision being made in bilateral corridors that never touch U.S.-controlled infrastructure. The UAE is not leaving the system. It is learning how to operate around parts of it without breaking the relationship. And that is usually the point where systems don't announce change anymore. They just stop being singular. What matters next is not whether the dollar is strong in aggregate. It clearly is. The question is narrower and more uncomfortable for policymakers. How much of that strength depends on behavior that is no longer automatic? Because if you look at the data Washington usually cites, the picture still looks stable. The IMF's COFR database shows the dollar holding a majority share of global foreign exchange reserves, fluctuating but not collapsing. Treasury auctions still clear with strong demand. Even during rate volatility cycles, global institutions still treat U.S. debt as the core collateral layer of the financial system. On paper, nothing is breaking, but paper statistics are slow to register architectural change. The UAE case is useful precisely because it sits inside that contradiction. It is not a country exiting the dollar system. It is a country preserving every major dollar linkage while selectively removing dependency in specific transaction layers, especially energy trade with China. That separation matters because it creates a split identity inside the same economy. One part still optimized for dollar liquidity and U.S. financial integration, another part optimized for bilateral settlement efficiency with Asia. This dual structure is not unique to the UAE. It is becoming more visible across Gulf-Asia trade flows. Saudi Arabia continues to price most crude exports in dollars, but discussions around partial non-dollar settlement in specific bilateral contracts have surfaced repeatedly in policy circles since the early 2020s. Indonesia and China have expanded local currency settlement frameworks for trade. Malaysia and Thailand have explored similar mechanisms through ASEAN financial cooperation channels. None of this dislodges the dollar, but it changes something more subtle: the cost of defaulting back to it. Once alternative rails exist, even in limited form, they become embedded options, and options in financial systems matter even when unused. They change negotiation power. They change pricing behavior. They change what is considered normal friction. There is also a geopolitical layer here that is easy to misunderstand. From Washington's perspective, the dollar is not just currency. It is infrastructure leverage, sanctions, compliance systems, correspondent banking controls, and global liquidity management through the Federal Reserve. That toolkit still works because most global trade still depends on it at some stage. But infrastructure leverage only remains absolute if participation is unavoidable. What we are seeing instead is selective avoidance, not exit. And selective avoidance is harder to counter because it does not trigger a unified response. It spreads quietly across different sectors: energy here, commodities there, infrastructure finance elsewhere. Opinion line. I think the most underestimated shift is not China's rise, but the normalization of non-dollar completeness, the idea that a trade cycle can finish end-to-end without ever touching dollar clearing. Doubt. But I am not convinced this will scale uniformly, because liquidity depth and crisis safety still overwhelmingly sit inside dollar-denominated assets, especially U.S. Treasuries and offshore dollar funding markets. Prediction. Over the next decade, we are likely to see a hybrid equilibrium, where the dollar remains dominant in global reserves and crisis liquidity, but loses its role as the default settlement path in specific high-volume bilateral trade corridors. There is a historical warning embedded here, but it is not about collapse. It is about fragmentation. Systems rarely fall when they are replaced. They weaken when they become optional in places where they used to be mandatory. And that brings us back to Washington's core blind spot. The assumption has been that as long as the dollar remains central in global finance, peripheral experimentation does not matter. But the UAE-China corridor is not peripheral in energy terms. It is part of the core commodity flow of the global economy. Which means this is no longer a side experiment. It is a stress test being run inside the system itself, without anyone officially calling it one. And the results so far are not dramatic. They are incremental, repeatable, quiet, which is exactly how structural change usually looks before it becomes impossible to ignore. There is a point in every monetary system where the conversation stops being about strength and starts being about friction tolerance. Not how powerful the currency is, not how widely it is held, but how many steps a transaction is forced to pass through before it is considered complete, and how many of those steps are still mandatory rather than optional. The dollar's global position was built on minimizing friction for everyone else while centralizing it in one place, US controlled liquidity and settlement infrastructure. That design worked because alternatives were either too fragmented or too politically risky to use at scale. What is changing now is not fragmentation alone. It is standardization of alternatives inside specific corridors. The UAE-China energy channel is a clean example because it sits at the intersection of three systems at once: Gulf hydrocarbon exports, Chinese import demand, and global financial infrastructure still heavily dollar-shaped. When those three overlap, even small changes in settlement behavior matter more than they would in isolated trade relationships. In practice, what we are seeing is the slow normalization of dual-track settlement behavior. A single exporter may maintain dollar invoicing for one class of contracts, long-term benchmarked oil sales, while using yuan-linked clearing for spot or infrastructure-linked trades. This is not ideological divergence, it is operational segmentation. And segmentation is harder to reverse than substitution, because substitution implies replacement. Segmentation implies coexistence. And coexistence allows habits to form without forcing system-wide alignment. There is a precedent for this, but it is not the obvious one about Sterling or Bretton Woods. It is closer to how global shipping insurance and offshore banking evolved in parallel to formal monetary systems in the late 20th century, quietly building parallel layers that did not replace the center, but reduced its exclusivity. China's role here is not simply as a currency issuer, it is as a builder of settlement adjacency. The cross-border interbank payment system, swap line expansion through the People's Bank of China, and offshore yuan clearing hubs in Hong Kong and the Gulf are not a single coordinated de-dollarization strategy. They are infrastructure pieces that make non-dollar settlement possible without institutional improvisation each time. That distinction matters, because once something becomes repeatable infrastructure, it stops being an exception. Opinion line. I think policymakers still treat currency dominance as a binary variable, either dominant or not, when in reality it behaves more like network coverage that can erode in pockets long before aggregate metrics move. Doubt. But I am not fully convinced these alternative systems have enough depth to handle synchronized global stress without reverting back into dollar liquidity, especially given how tightly U.S. Treasury markets anchor collateral flows worldwide. Prediction. The next phase will not be visible in reserve statistics. It will show up in contract architecture. More trades structured so that dollar conversion is no longer a required intermediate step, only an optional one. And that is where the UAE example becomes more than a bilateral story. Because once a major energy exporter and a major energy importer demonstrate that a transaction can complete cleanly outside the dollar system, even in limited form, the question stops being, can this be done? And becomes, why are we still doing it the old way for everything else? Washington's position is still strong, but strength in financial systems is not just about control. It is about default behavior. And default behavior is already starting to drift, not away from the dollar entirely, just away from the assumption that it must always be the middle step.